Now, I have about 5 or 6 topics I want to get to in this market commentary section before I get into index review and our stock watch list. The first one is what I've discussed over the past 2 or 3 weeks of videos about sometimes where the market's in a clear uptrend. We're above the 21-day moving average, the green line here in the chart, and it's pretty clear stocks are working out well. There's minimal distribution. Those are those 2 to 3 times a year I talk about in the educational videos when the market's healthy. There are other times when we're in a clear downtrend, when distribution builds up, we break below the 50-day, 200-day, and it's a clear time to get defensive. The time when it gets tricky is when there's mixed signals, when there's some distribution, some leaders breaking down, some holding up. We're right around that 50-day. And my conclusion over the past few weeks, I've sent this out in email memos to the members as well as in the recent videos. The conclusion is to stay defensive. When we're in this sort of pullback, corrective action, churning phase, which is normal for the markets, when it's not healthy and not in a severe downtrend, we're just building bases and having normal pullbacks. And the conclusion is to stay defensive. And how do you stay defensive? I talked about making sure to cut losses on any stocks that have broken significantly below their 10-week, because again, that's the area of institutional support. And if the institutions are not supporting it, then I no longer want to support it. And again, it all depends on a case-by-case basis, but that's just a general guideline for a lot of stocks. Raising some cash to protect capital, so you have some cash to use on the pullbacks, protecting your confidence, of course, and maybe using smaller positions. Let's say you have a big position in a stock, maybe reducing that, or on any new buys, using lighter than normal positions because we're in a higher volatility environment. And also part of it's just sit out power, having the discipline to just sit in a little bit of cash and just wait patiently for healthier conditions. Now, I'll get into my outlook more in the index review section, but bottom line is I'm still expecting some volatility over the near term. I'm not expecting any severe downside on the averages from here, but obviously on stocks, it's a case-by-case basis. And I will get a little bit more into that in the index review section. Now, the second thing I want to talk about is some members have told me, although tech and a lot of the NASDAQ stocks are correcting, there's a lot of strength in energy and in financials, casino, gaming, travel, shippers, those types of stocks, retail, and so forth. And the questions have been, how do you handle that? What about all the sector rotation that I've talked about that's keeping the major averages propped up, meaning while they're selling tech and other stocks, they're rotating into those other sectors that have been strong. And there's a lot of different ways to handle this. One way I've talked about is just to use ETFs if you want broad exposure. XLE is one of the energy ETFs. It's a little extended now here, but we've talked about this one before, OIH, the oil service, where you have Schlumberger, Halliburton. These are a couple of ways to give you broad exposure. As far as with retail, and you can just Google the major ETFs. There's 11 sectors in the S&P, and each one has different ETFs that XRT is retail, for example, if you want broad exposure to the retail sector. So that's one way to handle it, is through ETFs. You can trade individual stocks. I've talked about SM Energy, for example, we talked about in one of the webinars around $8, $9 coming off of this consolidation, and it's more than doubled since then. I didn't take the trade, but the whole point is you can trade individual stocks. Just stick with 2 major things: getting those strong entry points that I've talked about in the technical patterns video, and also using stops and managing your risk. We talked about FANG, Diamondback Energy, one of the energy names I like that has strong earnings. And we talked about in recent webinars, if you wanted to, I don't have a position in it, full disclosure, but I'm saying there's nothing wrong with individual stocks. Just make sure to get those strong entry points and use the same guidelines that I talk about. And again, you can trade whatever you want. Just because I'm not trading it, it doesn't mean you don't have to. You can trade whatever you want. Just manage your risk around those positions. Now, I personally don't want to chase some of these sectors because they've run a lot, and I don't know if these moves are going to be sustained. I could be wrong, but as more of a growth manager, I'm trying to stick with growth. These are more value sectors that have had good rebounds. And again, I could be wrong. I'm just not seeing a sustained move in a lot of these sectors, but we'll see. I'd rather wait patiently for the growth sectors because I feel over the long run, that's where you get the more consistent returns from. Now, this leads into a similar question, which is some members say it's frustrating when the tech stocks and NASDAQ is down, but the Dow and S&P are up. So another way to deal with this is to just take a position in the broad ETFs until more stocks and growth start to set up. For example, SPY is the S&P 500 ETF, Diamonds, DAI, if you want broad exposure to the industrials, some of the more, value, some cyclical names in the Dow Jones, some energy and so forth. You can grab a position, whatever you want, 20, 25, 30% position to at least have a position in broad exposure if you want to, because again, I don't feel that we're going to see sustained downside from the indexes because of the sector rotation. So, and in fact, this is a way I can use some of these. For example, I used QQQ, for example, off of the April lows when we had the fall through day on April 6th. There were a lot of stocks that hadn't set up until mid-April or later. There's nothing wrong with taking a position in the index, and then when it starts to consolidate and some stocks start to set up, then you can get rid of the exposure to the index and switch over to individual stocks. That's what I do, but if that's your flavor of having a concentrated portfolio of individual stocks, meaning have some ETFs until the stock set up if you want, is another way to deal with that situation. Now, the other topic I want to get into is I got an email from some members who had very difficult time over the last few weeks, larger than normal drawdowns. They were really struggling to take losses. When I talked about those breaking down below the 10-week, they just couldn't do it. And this is the part where I encourage members to make decisions. I give you a guideline. I can't come over there and click on the mouse for you. You need to be able to make decisions. And I said so many times in December and January, tons of times, that this is a strong market. This isn't normal. A lot of things are working. Don't get used to it. If you get used to bad habits and not stopping yourself out and managing risk, when things turn, you can get hurt. So there's a couple lessons I want to try to help with as part of the education of this product to possibly prevent some of these larger drawdowns in case you had one in the future. Now, first thing I want to say is don't beat yourself up. There's something like ARK Innovation, the flagship Cathie Wood ARK Funds ETF. From the top here in mid-February down so far, I think it's down 26, 27%. It was actually down 7% intraday on Friday. So this thing was down, in the mid-30% from top to bottom. Now, the difference between what she does and what you can do as an individual trader is she has to be fully invested, so she's constantly getting flows and has to put money to work. As an individual trader, you don't have that mandate. You can have some portion of your portfolio in cash. There's nothing wrong with that. I've said so many times, round numbers, if you have a $100,000 account, you don't have to have all 100,000 or be on margin and be involved. You can keep 40, 50, 60% in cash waiting for better opportunities so you don't get hit as bad, number one, and number two, so you have cash to put to work maybe on some stocks that you're waiting for to get down to some logical support levels. But some ways to prevent some of these drawdowns in the future, let me go back to the NASDAQ just to show you, is that when we start to get extended, and I talk about when we start to get extended from the moving averages, it's happened so many times over the past year and will continue to happen. Take some profits into strength. And I know it's difficult for some people because when things go up, things are going well and you have those emotions flowing and it's hard to say, let me take some profits, but there's nothing wrong with selling some. Again, it doesn't have to be an all or nothing thing. Just take some profits into strength to at least minimize your exposure. That's one way to try to prevent some of the larger drawdowns when things are going up and getting extended from some of the sell rules I've talked about in the educational videos. Take some profits into strength. Use smaller positions on new buys, or if you have a big position, let's say a 10% position in something, and it starts to really run, reduce it back down to minimize your position size. Also, the number of your positions. I know some people have told me they have 50, 100, 200 positions. That's way too much. That's over diversification, and it's impossible to keep track of that many stocks. So minimize the number of your positions. That comes with discipline and not having FOMO, fear of missing out. That's for weak traders, as I've said, where you hear people saying, oh, the people are in GameStop and people are in all these stocks that are running, and then you have fear and you want to jump into them. Get rid of that out of your mentality, because that way you end up with too many positions, and when the markets turn, you end up getting stuck in too many positions that are too hard to keep track of. Some people talk about writing covered calls. It's more of an advanced strategy, which I'm not going to get into, but that is one way. If you're a sophisticated and advanced trader, you could look into doing that if you wanted to. And the other thing is to just understand what's normal and what's not. I talked about so many names recently, in EXPI before the split. When you get a stock that runs from 40 to 80 in less than a month, it's not normal for stocks to double, especially a decent market cap stock that it got up to, 8, 9, 10 billion. When things double, just understand that that's not normal price action. So there's, you might fear, well, if I sell it, it's going to go higher. There's no FOMO, fear of missing out, because you didn't miss out. You did well on the thing. So if you take profits, and I even tweeted out that so many stocks just round tripped their gains recently, where they just had huge runs and gave it all back when I was going through my screens. And one way to deal with this, as I talked about in the sell rules, is selling some into strength. There are just so many of these that, Triple D went from 10 to 56 in a short period of time. That's not normal. That's why I was saying all through December and January, this isn't normal, reminding people to take advantage of it, but also take some profits and to not get sloppy with your habits, because those bad habits can really, really hurt you if you get used to, for example, not taking profits and not stopping yourself out. I could go through a million examples. Novavax, same thing, broke out of the space, ran up from 100 to over, 140 to 300 and something. Well over a double, and gave it all back. But that's why I was talking about, whether it's some names we talked about in the videos or in the webinars, VERU, which ran up here, had sort of a high tide flag. When it goes from 10 to 24 in 3 days, that's when you have to take a step back and say, this isn't normal. This is great, but take some profits, even if you sell it early, because so what if it goes higher? The more it gets stretched like a rubber band, it'll eventually snap back into your face. FLGT, we talked about around this 50 range, breaking out of this base. And I know one of the members who said they were mad because they sold it at, I think, 110 or 120, and then it just kept going higher. Well, it happens sometimes, but the whole point is, number one, be happy if you get a double or more than a double on a trade. And number two is, if you're not going to sell it on the way up, you're probably never going to sell it. And then you're just going to watch it go up and then eventually come right back down, especially when things get overly extended. So I just want you to understand what's normal. Going back to Cathie Wood's ETF, I'm not picking on her. I'm just saying that she just had, I think, 150% year, and going into middle of February was up another 20%. This is an ETF. Yes, it's a concentrated portfolio of high octane, high beta growth stocks, but when something's up 20% the first 5 weeks of the year and the market averages 8 to 10% for the full year, that's what I mean by understanding statistics, that when certain stocks double or an ETF or an index goes up that much, that's when you have to say, hey, this isn't normal. This is off the bell curve of statistically normal things that happen, and understand that and take some profits. Now, the next thing I want to get into is being married to positions. I talked about this in the educational video. I'm not picking on any of these stocks in particular. I'm just trying to give you some examples. There were many stocks last year that were up 100 to 500% during the year. We get married to these positions sometimes because we're not used to having nice gains, that when something treats you that well, you just fall in love with the company. You think it's going to go up forever, and you absolutely love it. Just keep in mind, the concept here is, after stocks make huge moves, they need to digest those gains. Peloton is one which we talked about a while back, coming out of this base in the 30s, ran to 170. The growth is amazing. It's a great story. I'm not saying they're going out of business. I'm just saying understand that now this is the left side of a base that could take time to build. I just say statistically and probability-wise, it's doubtful to see this thing just snap back to new highs. It will probably take some time, and just accept that. My point with these stocks I'm going through is I'm not saying sell them. I'm saying understand that after huge moves, they're going to take time to consolidate. Zoom went from 80 to 600, literally one of the most amazing growth stories in the history of the markets. Had great earnings. Now the year-over-year comparisons, it's going to be hard to grow 700-800 million in revenues at 300-400%. Is it still a great growth company? Absolutely. Is the stock most likely going to consolidate for a while? I would say yes. I don't know how long that while is. I'm just again stressing that it's going to take some time. I can go through so many of these names fastly, from 20 to 130. A lot of people are in love with this stock. It's going to take time for some of these to reset their bases. Net from 20 to 95. I could go through so many of these. I'm picking stocks that a lot of people who might be watching this are probably going to get upset because they're like, I love these stocks. I own all these stocks. What are you trying to say? I'm not picking on these stocks. I'm trying to teach the concept of when a stock goes up 100, 500% or more, and they consolidate and they break down, they're going to need time to consolidate, and you just need to understand that. You know, something like Teladoc and Tesla, for example, these are great companies, and if you love them longer term, then you can stick with them if you have a strong entry point. Just understand, as I've said 100 times, it's going to take some time. Even something like DocuSign, we talked about coming out of this initial base after the follow-through day in early April of last year, from 90 to 200 and something. If one of the sell rules is sell on a gap and the biggest up day of the whole move, if you sold around that time, 250, 270, something like that, think about how you don't have to deal with the frustration for several months of it just chopping around and doing nothing and potentially needing to consolidate for a while. Think of the opportunity cost. If you sell on some of the bigger up days, you can take that money and rotate it into something else. These are just suggestions that I'm trying to bring up. Now, some examples that I talked about, for example, would be Square. Let me take a look at the weekly chart. When Square went from 10 to 100, it was an amazing move, great company, everybody loved it. Now understand, once it starts to break, it could take 2 or 3 years to consolidate before it eventually goes higher. Roku was the same thing. Roku went from 40 to 160, monster move, and then it had 2 big leg downs before it went sideways for a couple of years. In fact, came down to 58, almost gave the entire move back, and then before it went higher. So that's why I'm giving you just a simple example. I could go through so many more. Sorry to be a broken record, but when stocks make monster moves or indexes make huge moves, understand they are going to need time to consolidate. I'm not saying to sell. I'm just saying if you like them longer term, you're going to have to be patient, understand what's normal, and that digestion is needed. Another example I've loved is Zillow. Longer term, we talked about this breaking out of the 2-year base here at 60, and I no longer have a position. I took some profits into it, and I thought it was going to be up about 50% within a year, and it ended up going up well over 200% in a short period of time. And great story, still like it. Now, I no longer have a position. I'm going to wait for it to reset its base. Now, the last topic I want to get into before I get into index review and the stock watch list is some members emailed me, why is this correction happening? What is going on? Is it all the 10-year? This may sound a little bit odd or maybe whatever. If people think I'm crazy, I don't care because I am a little bit. But anyways, my point is that I think this is more psychology. I think the market, as I've said, I'm bullish longer term, but along the way, we're going to have shakeouts, pullbacks, corrections along the way. Why? To let stocks digest, number one, and number two, to keep the bulls in check. I think when we started to run here, it was after that week of GameStop at the end of January, we started to run everybody's on margin. Everyone thinks they're King Kong. They're the greatest traders ever. People were doing very, very well, up nicely, double digits nicely early in the year. Everyone thinks they're great. And the market has an amazing way when you get cocky, when you think it's easy. It has an amazingly convenient way of sort of punching the bulls in the face just to keep them in check. I think this was more psychology, just like when people get incredibly negative, the market magically turns around. When people get incredibly, a little bit of too much euphoria and everyone the sentiment gets off the charts on the bullish side. I think this was more of a psychology move because at the end of the day, the 10-year at 1.3, 1.5, 1.7 historically is very, very low. Yes, the velocity of the move might have scared some people, but I think that has less to do with it than just the beast of this market that likes to mess around with psychology in my 20-something years of doing this. That's just my feeling. And I also want to say we're still going to have these corrections. They just seem to come, as I talked about, seismic corrections, meaning, let me go back to the S&P, meaning the S&P will sometimes correct 4 to 6%, but beneath the surface, it's like on steroids. Everything's just sped up with technology where the S&P, let's say, will correct 4 to 6%, but growth stocks beneath the surface will correct 10 to 30%. And I think that's going to happen, which is why you need to take profits into strength once in a while, because that way it'll help mitigate those drops. That's why I talk about you don't need to always be very invested. Going back to the NASDAQ here, I use this example at the end of August of last year when we started to get extended. I said I was moving to 50% invested and I had 50% cash. Now the NASDAQ in the early September last year dropped 10% in 2-3 days, and I ended up dropping 6% because I was 50% invested. If I was fully invested or on margin, I could have dropped 10 or 15%. But that's what I mean by, again, the lesson is when we start to get a little stretched to help deal with these brief bursts of corrections where it seems like growth stocks just get annihilated in a short period of time, is to take profits into strength, reduce your exposure, reduce position size. And that example, when the market drops 10 and I drop 6, that's manageable because I had plenty of cash, and hopefully that makes sense. Now let's move on to index review.